guys exited Rexon to SL Green, I think for like $6 billion. How'd that happen?
My son, who at the time was 11, came up to me and said, "What gives you the right to sell that business?" I said, "Elijah, you don't understand. You have to trust me on this one." He goes, "Dad, this is going to be the biggest mistake of your life." We've signed up our deal with SL Green, and then right before we were supposed to close, Carl Icahn came out and offered a topping offer without even notifying, just sends a letter. What the hell is this guy talking about? It all happened during the day of my daughter's bat mitzvah, so we have all family in town, and I had to basically take one of the hotel rooms that have bankers and lawyers, and it's on CNBC, and my son walks into me and said, "Dad, I told you, this is going to be the biggest mistake of your life."
Safe to say that might have been one of the most well-timed trades you ever made. Scott Rechler, founder and CEO of RXR. Welcome to Change Order.
It's great to be here. Thanks for having me.
Well, excited to have you on. Just after Thanksgiving, you were telling me about the 3 different turkeys that you were making, and looks like we both like to cook a lot, so that was exciting to hear. I wanted to start off with a conversation we were just having about founder drift, and we're coming out of a recession or some sort of a massive market dip. What had happened during that market dip, do you think, and what does founder drift mean to you?
Yeah, I think, as people get successful, their own, the expectations they have for themselves and the expectations other people set for them, sometimes it distracts them and moves them from the lane that they were on that drove their success. And a little bit of it, they feel almost invincible. They could do more than they otherwise might be able to do, because they have that success and that feeling of success that they think is transferable. And so they drift into areas of businesses that aren't consistent with what made them successful. And you see a lot of really good business people, over time have moments in time where they actually have some of those drifts. I've had them myself, and it's easy to get distracted and, see something that seems exciting and decide you're going to spend some time on it. When you have an economic downturn, it really is a great means to force you to refocus, right? Focus on the fundamentals and making sure that you're driving your business into the competitive advantages that you have, the edge that you had, and you're leaning into that as the basis of growth. And not being distracted by some of those other elements there. And it requires a level of discipline, in terms of deflecting deals that come in or opportunities that come in that could be very exciting, but if they turn out not to be, they become major distractions and dilute the effectiveness and long-term growth of your business.
I think there was a quote that one of the best money managers out there in the market said you had the most well-run firm in the real estate business back in the day, and probably still to today. How do you try to keep that focus internally at RXR?
So, a lot of this is having a real good strategic foundation. And one of the things that we do every year is we write this comprehensive white paper, which we've been doing now for almost 2 decades. And the concept is try to drown out all the noise of the market. Like everything you hear, everyone is talking about what they want to do, where they think things are going, and try to have an eyes wide open approach as to what's happening in the world, what's happening in the economy, what's happening in your markets, what's happening with your customers and your communities, and how is that going to impact your business? What other opportunities are there that are down the road? What should you be thinking 1, 3, 5 years out from now in directing your business? And then from there having coming out with a real set of conviction that this is what you're aiming to do. Now the opportunities may not intersect with where that conviction is right away, but if you're looking for it, you'll lead the market to where you're going, and then you take the time to push those themes down throughout your entire organization. And when you take the time to write something down like that, it has a lot more meaning. It also serves as a great baseline for you to go back on a regular basis, which we do during the year, and say, okay, we thought XYZ was going to happen. It didn't happen. Should we recalibrate for that different reality? Or is it something that's going to be happening soon? Or if there's an opportunity that does come and that we see, and it's not necessarily ideal for everyone, we'll be able to react with a level of conviction and intensity that others might not. And then just even organizationally, do we have the organizational team and muscle to be able to achieve where we want to go based on what we're, the strategy that we've laid out. And so if we don't have it, we'd start recruiting, we'd start thinking about reorganizing our team in the right way. Let's making sure that we're putting our resources, both people and capital, in a place that's consistent with the strategic themes that we have laid out in that white paper. And then to the point we were just having before, also let that be the guardrails of discipline, right? That so when things do come in that aren't consistent with this, deflect them quickly so we don't have the opportunity cost of allocating too much time to things that are not going to be ones that we really should be doing based on where we're trying to grow. And so this has been part of our culture. I used to do this myself and then wrap in my partners. And now it was a team of 5 of us that, take the lead and spend time talking to all of our team members and our customers and other stakeholders to try to get a comprehensive view of what's happening and then refine this document into, last year's was like 45 pages or something like that. And so it's a pretty comprehensive document that we live by.
Is that 45 pages with appendices or actually 45 pages?
But this had some photos in it, but we've had ones that were 60 pages. And
that's amazing.
And we've had some major strategic pivots. I would say almost every strategic pivot that we've had was, initiated in one of our white paper sort of writing and thought processes.
Did you create a template for this, or did you take a template from somebody else?
I created a template, and it was at a moment in time where I was trying to sort of get clarity as to where we were going. It was sort of a pivot point in our business, and so I said, okay, we have to think this through. What should that be? And so began to write and research, and then it just over time, it has evolved to be a pretty, foundational part of our the way that we grow our business and operate our business.
Was there anyone that inspired that?
I'm not sure who necessarily inspired it, but when we went public, I spent a lot of time reading books like from Warren Buffett and other great investors. Charlie Munger, what makes a good company? What makes a good company work, right? And I think that helped instill in me a concept of trying to really be thoughtful and disciplined as an investor and operating a business.
And how long does that process usually take end to end?
So we actually have our kickoff meeting today. And we'll be doing this now, and we'll finish this from now until I would say the 3rd week of January. So it's and then we meet every Wednesday. Today's the sort of the kickoff, but Wednesday we'll meet again. And then I already throughout the year have been collecting notes, and as we get closer, I have a whole file of themes and notes that we work through, and then based on those, I take the lead of writing the overall sort of macro outline, and then we then divide it up to the team and then engage other team members to help provide some of their insights and then work our way through it.
That's great. I feel like LLMs might make that a little easier for you this year.
It definitely could.
I think it's really interesting because when you do read about, whether it be Warren Buffett or Munger or even Marx, these guys, they sit down and they read a lot and they think a lot. But there's really a difference, at least from my perspective, between people who can be great investors and then people who can be great firm builders. And from everything I've seen, RXR is just a great firm. How do you think about the difference between people that are great investors and great firm builders?
Yeah, there's a lot of differences there. That's a very good point. And I think we have always considered ourselves more a builder of businesses than just a builder of buildings, right? We want to build businesses that have competitive advantages, that have that lean into our expertise, that are consistent with our long-term objectives and values as a firm. And I think when you think of yourself as a enterprise builder, right? You spend as much time on that investing in the enterprise, and as you would as underwriting a particular investment. And so it's cultivation of people, it's mentoring of people, it's acknowledging that it's time to rotate some people out so other people can grow within the firm. And so there is a very different psychology about it, and it's much more. I think you need to be much more engaged with your team, whereas an investor you can be, much more isolated in your investment decision making as you go forward. And I think it's harder and harder to be just an independent investor today, right? Because everything's more complex. You need a lot more resources. So, and you get big quickly in that context of things. So if you're going to be an investor, I think you need to be able, if you're not going to be the team builder, the company builder, you need to have a partner that has that capability, right? And I think, fortunately at our firm, we have a number of our partners focus on team building, and mentoring our each of our executives on their way up, and as we go through the process, and focusing on that organizational design. And then you want to build a culture where you want to maintain that entrepreneurial edge, right? So that's something that's really important at RXR. Is we don't want to become bureaucratic. You want to have an open door, flat culture, so that everyone feels they're part of this and they're entrepreneurial, and it's okay to take some chances, and if you make mistakes, learn from them. But that's not going to be someone that is going to come down and the end of your career because you make a mistake. We want people to have that sense of ownership and that pride of ownership of being part of the firm in that area as well. And then treating your teammates that way, right? We call it one RXR, right? Which is that we're only as strong as we are, collectively versus individually, right? So this sense of collaboration is key for particularly a firm that's as multidisciplined as our firm, and that you need that all to interact together to be successful. So having silos don't work in a firm like ours.
And how do you get that entrepreneurial mindset, though, to kind of bleed down into the organization? Because when I think about real estate, I think about the fact that you set projects, you start developing them. Once there's stuff in the ground, it's there. It's not like software, which we can quickly change. And so the magnitude of mistakes, it's a lot different. We always talk about one-way doors versus two-way doors. If it's a two-way door, go ahead, just make the decision and run on your own. But when it comes to real estate, it feels like there's a lot of one-way doors.
Yeah, no, well, I think that, and the time from when you're making a decision to when you're actually delivering a product on the development side, it could be, is you could watch multiple cycles and environments change during those periods of time, which makes that more complicated. So, the rigor in your underwriting and trying to think through different circumstances that might play themselves out, and then sensitize the impact of that and how resilient is this investment to those different outcomes is a key. But the entrepreneurial part is both on the ideation of where is that investment and the formation and the structuring of where that investment opportunity comes, as well as that once it's handed off, every person on those jobs or in those buildings bring an entrepreneurial edge to those projects, right? Whether that's the people on the construction site trying to figure out how we're going to value engineer, or how we're going to overcome a challenge. We're building a $4.5 billion airport at JFK International. There's always something going on. The people on the ground got to figure out how are we going to deal with that, right? It can't be a roadblock in the way there, or people that are managing and operating our multifamily buildings or our office buildings, even to the person at that front desk, that concierge, that security person, that's the first interaction that people have when they enter our building. So for us, we take them through training about how to have hospitality, how to treat people a certain way, creating a warm and welcoming environment, having a sense of personalization, some surprise and delight moments, right? Things like that are key. But these are all entrepreneurial ways, and I always say it doesn't have to be at the very top. Everyone within an organization should have that sense of ownership and be find a way where they can have some edge, some entrepreneurial edge to enhance RXR's competitive advantage, either with our customer or one of our vendors, or with the projects as a whole.
Yeah. George Tenet, we had dinner with him one time. He's the former director of the CIA, and he said to us, "You need to make sure your employees feel like owners, not renters."
Right.
And I feel like that's like what you're describing. It's like feeling a real sense of ownership and pride for the work that you do day in and day out. And if you can get that in your culture, the outcomes tend to be better. It feels like.
Right. So, just on a tangential to that, I say to our team, I said, that the success is not owned, it's leased, and rent is due every day. And so, you got to get up every day and not complacent that things are going to work out. You got to go out and find ways to be successful and reprove that you can do it every day.
I love that. I was talking to one of your colleagues recently, Matt Boris, and aside from the fact that he mentioned you have probably the best work ethic in the industry, he also said that one of the things that impresses him the most is just your in-depth knowledge of basically every role at the firm. When I was reading about your background, I mean, you became an executive at 26 years old. You were just talking about how you were reading about things, going into the IPO of your firm, which we'll talk about in a second. But how do you approach that? Like, how do you get into the weeds, like day to day, and how did you learn all the different parts of your business?
Starting young, right, and building a business, you sort of have lived through every part of those building the businesses, and sometimes it hasn't been as sequentially optimized as it could have been for me, right? Because you're sort of going, and I'm sure like every entrepreneur, that's the way it is. But then as you live through these things, these different elements, you learn. And I have the advantage of having a great team of experts in-house. So if I got to dig into anything, I can bring in the right group of people that understand those disciplines that will educate me about what I need to learn, right? And that's something I rely on a lot. And that's if you think again, there you have the respect that you don't have all the knowledge. So the people that do have that knowledge, you really want to be able to make sure that you tap them and try not to go it alone, right? That's why you have them there. They're a resource that enables us to be more successful. So I spend a lot of time learning from them. I'm an early riser, and so I read a lot. I write a lot.
What time?
4:45.
Wow.
So I do and it's discipline's a key thing for me, right? I mean, discipline is a big part of my life, and I think a big part of an executive to be successful is being disciplined. And then when I say discipline, not just on work, but also work-life balance as well. You have to be disciplined about fitting that into the mix there, right? So it's when I do my morning routine, I call it, it's my mind, body, and soul, right? Which I spend time reading and studying, and I do put myself through an intense workout, and then I take some time to read spiritual stuff and pray and things of that nature as well. So it's like you got to sort of find that grounding in that mix there. But if I skip, and I write in a journal every day, which is the reflection. So when you skip those moments, you can feel off balance, right? And so it's important to try to find what works for you, and that creates that sort of that inner self where you're well balanced and positioned to be the best you can be.
And so you created a lot of structure for yourself, it sounds like.
Yeah, no, I find that, again, for me, just even from the white paper on, right, the more structure you have, the more you have the ability to sort of to get more done, more productive you can be. Doesn't mean that you shouldn't sometimes jump out of it, but I think that it leads you to new ideas, right? And now I sit on the New York Fed board, and we meet every 2 weeks and have to share with our other board members where we are, what our perspective in the economy is, and vote on discount rates. And so that's a whole nother area over the last few years that I've had to develop, where on a daily basis I'm consolidating notes as to things that I'm seeing relative to economic trends. And then, by the time I'm in that room, I have my 5 minutes to 10 minutes to sort of share my views. I've now been able to consolidate these thoughts from the last couple of weeks, right? So it creates another sort of retraining of how your mind works, because now you're constantly trying to take observations and making sure that you're identifying what they could mean, and then you get to hear your colleagues give you a similar set of perspectives every 2 weeks, which is a very unusual thing to do. So it's another model, but again, it's an example of sort of having a process in place,
Yeah.
keeping track of those notes, and then using them at the right time.
And so in your organization, as it's continued to grow, have you made an intentional decision to go around and sit down with employees on like a monthly or quarterly basis to understand what they're doing, or is it more in like an ad hoc per project basis?
We have a set of meetings that are set up, like literally every day at 12 o'clock, we have a 30-minute, sort of go around the horn with about 20 of us as to sort of key, either investments or capital market initiatives, but just as a quick snapshot that we all sort of hear what's going on, all the executives at one time. And then, from there, we can have next rounds of meetings where smaller groups get together and dig in. Then we have a couple times a week project specific meetings. So if we have larger multi-year projects, we'll have an hour set for per week for a couple of them, and then that rotates every week. So gives us an ability to sort of keep track of where things are going on that front. And then obviously we have business plan meetings, quarterly meetings, organization meetings that are set up, and so a lot of meetings. We try to make them productive along the way, right? That's the key in this thing is to make sure people come prepared, do their homework. We always get these decks in advance, and then a lot of ad hoc meetings. I call them around the table meetings, where I can usually have 6-7 people around my office table, and we're brainstorming around a new opportunity, or around a strategy, or around an organizational adjustment, whatever that might be.
It's fascinating. I was just listening to a podcast this weekend, and I heard about Elon over at XAI. For better or worse, he ended up going to every employee and he gave them a 5-minute time slot to go, explain what he was working on. And I don't know if you've been following the data center build out that he did, but the speed at which they've moved, most folks in the construction world look at it and are like, this is insane. It was impossible. But, I think one of the things that's interesting about him and the way his mind works is he can go sit down with an employee, give them, the freedom to explain what they're working on. They feel seen, but at the same time, he can identify the bottlenecks and like the connective tissue between jobs and try to figure out like how to remove those. And I just think it's amazing when you can find founders that can kind of go and like into the depths of their business, and then at the same time unplug themselves and look from the bird's eye view and like let people operate. And it sounds like you guys have done a good job of balancing those two things.
Yeah, what surprised me most about Elon Musk is that he actually can do it for so many different organizations. I think that's where, where in the past where I've had multiple businesses that we're running at one time, that's where it gets challenging, because it's almost impossible to be able to do that well in multiple businesses, right? To have that pulse on your business if you have 5 of them, right? And now maybe 6 if you count the U.S. government, right?
I don't know if I'm going to count that one yet, but I will see. We'll see. They have 2 years in order to execute on that. Well, to shift gears for a second, we talked about you were, I think, 26 years old when you were over at Recession, and you guys decided to IPO. I want you to just like take me behind the scenes for a second. Like, what was that process like for you? How did you guys make that decision, and what did you learn from that?
So, you got to sort of rewind. And I came into Rex, which was my family's business. My grandfather, my father, and uncle had started it. It was 1989. It was a time like today where the real estate industry was turned upside down, and what was really a parochial local business was becoming much more institutional, because you had the savings and loan crisis, the RTC, you had a whole round of restructuring that had to be done. And it was a paradigm shift that was taking place. And so when I came into the business, I was also finishing up NYU grad school. And so I came with a lens that was different than how my father and uncle had run the business in the past. And then you saw coming out of the downturn, which again, like now, this immense opportunity of a reordering that was going to take place, where a lot of family businesses that were like my family business were sort of stretched. They had, they're in the next generation. They realized that, what worked in the past isn't going to work in the future. So they were all trying to reflect about what to do. And so myself and my brother and cousin, and we said, let's go take advantage of this opportunity by going public and then acquiring other family businesses that were a multi-generational businesses to build a platform that would give us scale. And at the time we were $300 million, and we ended up buying a business in New Jersey, in Westchester, in Connecticut, and ultimately Manhattan, and use that platform to do more value-added type structures and create, integrate a larger firm along the way. And I think, part of this and the rationale was an acknowledgement that, to really build the governance and the strategic, capabilities and access to capital to grow a business that's an enterprise that we were talking about before in that changing world, the public markets was the right venue at the time to do that, particularly transitioning from a family business to something more professional, because you now had, independent board members and shareholders that held you accountable to that, which is, easy, creates an environment that's more conducive to, creating a meritocracy and focusing on achieving goals than you would have in a more laxed family environment, right? And so that was the purpose around it. And it was, at 26 years old, I remember going around, meeting Fidelities and all these, big, investors, and they couldn't get their head around that I was so young in the process, because in the real estate industry, different than the tech world, that was not a common situation. So we ended up getting public in 1995, and then began bringing in other managers that joined. So Mike Matoro, who's a partner of mine now, and Jason Barnett is a partner of mine now, joined as sort of the two first non-family executives to the firm. And then we kept growing. And, it was initially, going back to my point about Warren Buffett, initially when I had, as a public company, the concept was think as your shareholders as your partners. And that worked well, I would say, through 2001, because what happened in 2001 was that after the tech bubble, the regulation that came in was Reg FD, which meant, full disclosure. So if you were my investor and I came to you and I said, I'm thinking about this strategic expansion to do, student housing or go to some other part of the country, they would, give me their feedback, and I could digest it as part of, our plans. In post Reg FD, if you had that conversation, you have to post it on your website and share with every investor. So your ability to actually have a shareholder that was a partner dissipated, and really what you had was a sort of a one-way conversation. You would announce something, then they would respond in after the fact, and so it became much less of a, in my opinion, effective way to grow a business. And also, you began to see the public markets were becoming much more restrictive as to what they wanted to see their managers do. They were getting paid themselves for portfolio management. So as I mentioned, we had a student housing company that we had co-founded in 1998, and was spent a lot of time building the infrastructure to grow that business, building the technology to grow that business. And just as it was picking up real steam, we were under pressure from our public shareholders to liquidate that, because they said, well, we want Rexon to be a New York office and industrial company, and we'll if we want to play student housing, we'll find a way to play student housing. And so, that was, a frustration. We had also a logistics company that was a big box logistics company that we were building around the country. And so we actually sold that business. We took our student housing company public in 2004, American Campus Communities, and ultimately it ended up selling to Blackstone a couple of years ago for $13 billion, the largest student housing company in the world. And we saw all that work, and then because the public markets were saying, time to stay focused, we missed that opportunity. So we're actually in '04, we decided that the public markets weren't consistent with how we wanted to grow our business. And I always say, you got to match your capital structure with your strategic plan, right? So, going public works for some people if your strategic plan is consistent with that. And you got to recognize also, this isn't a financing; it's a way of life. It's a marriage, right? And it's very hard once you are public to not be public again. You're not, it's hard. You're not going to just go private, right? So we ended up waiting for the markets to get to a point where we can execute a trade. and then sold in January of 2007. But we had decided really in '04 that we wanted to get out of the public markets.
So you don't want to be a public company CEO again.
Right, exactly. I mean, I'm not gonna say never. And again, there's, as I said, you match your strategy to what that is, but it was definitely not for where we were trying to grow our business.
Yeah, at the time.
And where we saw the change, the world was starting to move so quickly, the way people use space, lived, worked. And so to be boxed into a strategy was something that was not compelling to us.
There's this huge argument going on right now, especially in the startup world, because companies have stayed private for so much longer that they should really be going public. And I think what's interesting about what you're saying is the fact of the matter is, unless you're going to stay like true to your core strategy, there's a really high probability that the public market investors won't appreciate, won't understand what you're really trying to build, and won't actually either A, let you, because they might just get rid of you, or B, pay a premium for it. And I think if you look back at the history of a company like Amazon, for instance, like completely misunderstood stock, Uber, same thing. And I do wonder if we need to start to put companies in the startup world in two different buckets: those who are likely going to stay in their core business and they should be going public, and then those that really want to invest for the long term and might be able to get access to the private market capital and should be staying private longer.
Yeah, no, it's interesting. Over time, and I think more now, even coming out of this cycle, there's been capital formation both on the credit side and on the equity side that I think enables companies to stay private longer and still have access to capital, and benefit from that, right? And even in terms of liquidity, if sources, if there's someone, one of the founders or one of the partners needs liquidity, the secondary markets that have been developing, the credit markets that have been developing, the different types of financial tools that are out there that didn't exist historically, right? And there's more transparency because of technology that people can actually get comfortable in that regard as a private company. So why be public? One is raising capital. One is an exit for the initial investors that were there, or some of the founders. One is the brand identity. Does that help you with the brand and credibility? Is it also a currency to do M&A activity? So there are reasons you might do that, but you need to be thoughtful about what those implications are. It is, and I still see it today with entrepreneurs that come to my office and talk about wanting to go public, and you could see there's a sex appeal about it, right? An excitement about it that isn't necessarily driven by rational facts and circumstances, but by the concept of it's like ringing the bell, right? And in business, different than sports, where it has a beginning and end and a scoreboard. You don't traditionally have a ring in the bell moment unless you as a company can find ways to effectively create those environments and those metrics and milestones.
In many ways, the ringing of the bell is just the starting gun for the next chapter.
That's right.
I wonder, you just mentioned that there's now this highly efficient private market that's popped up over the last couple of decades. And I would totally agree with you, by the way, even in the startup world. Do you think that's a good thing or a bad thing?
I think it's a good thing. I think it's it's another level of financial plumbing that I think will make our economy stronger longer, right? You see it just in my world on the private credit space, which is an area we're very active in at RXR. But if you've seen and you go back and look through history, and the New York Fed gave us some graphs in this one of our meetings, that after each downturn, the amount of private credit versus bank credit jumped dramatically, right? Whether that was in the early 90s or after the great financial crisis or now, and it's typically driven by either new financial tools that were created like CMBS or MBS, or it's driven by the fact that the regulators have become stricter on on public depository type lending, and so the private sector has stepped in. And this when you think about it, in real terms, though, that's actually a safer place for this to be, because you have more sophisticated people that are now originating these loans. They have capital that has a duration that better matches those loans versus a bank that has a deposit comes in, can be pulled out the next day. Here, you're matching those durations, and it creates more liquidity in the marketplace, right? Through that process. And if there's a hiccup, at the end of the day, people will lose money, but it's not the public that will lose money. It will be the institutional investors themselves that lost money, that are sophisticated investors that can make those decisions to do that. So I think it's healthy. I think on the equity side, I think it's healthier in the sense that it keeps going back to our earlier conversation about drifting. It keeps the management teams focused on performance, right, and not necessarily valuation. And we've seen over each of these different cycles, management teams, particularly in the earlier stage companies, being forced to grow at a faster pace than they're capable of, or the market's ready for them to grow at, which has then led to challenges that demand to grow was, when can we create an exit, right? That and if that's the goal, and it's a public exit, that's a challenge, right, along the way.
It's a new chapter. So speaking of new chapters, you mentioned that you guys exited Rexon to SL Green, I think for like $6 billion back in, was it 06?
Oh, January of 7, yeah.
January of 7, okay. How'd that happen? Like, walk me through what your mindset was at the time and why you decided to go with that acquisition.
With that disposition, the rationale started in 04, really, was that we saw our strategy wasn't real. The public markets wasn't going to be accretive to our strategy. It, frankly, was going to hold us back for what we wanted to do. And while we loved Rexon and the franchise and the team that we had built, there was no easy way as a public company to shift that strategy without creating more challenges. We actually had brought in Goldman Sachs to help us evaluate this and report to the board, is there a way to do this? And there wasn't. So, again, being a multi-generational family business, not an easy decision to actually have to do. But when we started to see more liquidity in the market, and there were a number of trades starting in 06 where you can find multiple buyers that can actually afford to do $6+ billion transactions. You said, okay, this is a window of opportunity. And as a public company, the last thing you want to do is try to go out and sell your company and fail, because then you lose the trust of your stakeholders, your employees, your partners, your board, your investors. So it takes a while to regain that trust. So you got to really make sure you're going to be able to execute. So so things lined up that we felt we could execute. It was literally that summer of the 06, and trying to give some thought about how to do it, and retained our bankers at Goldman Sachs and Citigroup to give her some thought. And I remember the Sunday before we were going to kick off the process, my partner Mike Matoro came over at the time, who was our CFO and president, and said, listen, I know this is your family's business, and we know that valuations are high, and we know it's limiting some of our growth, but we don't need to do this, right? This is something we think makes sense, but we don't need to do this. And I want you to know that from the company standpoint, we're with you if you want to just keep this as a public company and not give up the family business. And I told him how much I appreciated, how much it meant to me that he thought that way, but I thought it was the right thing. We thought it through, the right thing for our shareholders, for our employees, for us. To make this move. And so he left, and then I was barbecuing that night, and my son, who at the time was 11, came up to me and said, Dad, I heard you and Mike talking. I said, yes. And he said, he talked about selling Rexon. I said, yeah, I think it's the time to do it, where the market is and where we were trying to go. He said, Dad, that's not your company to sell. That's the family's company. What gives you the right to sell that business? And now I'm like all emotional. I'm crying on my hamburgers on the grill. And I said, Elijah, you don't understand. This is the right thing to do, and the right thing to do for all of us and for employees. And you have to trust me on this one. He goes, Dad, this is going to be the biggest mistake of your life, and walked away from me. So you can imagine how that was.
What happened after that?
And then what was interesting was we signed up our deal with SL Green, and then right before we were supposed to close, Carl Icahn came out and did an offer, a topping offer, without even notifying, just sends a letter. I found
That's
out by
Carl
reading
Icahn
about it in
does.
the Wall Street Journal, right? I'm like, what the hell is this guy talking about? And it all happened during the day of my daughter's bat mitzvah. So we had all family in town, and I had to basically take one of the hotel rooms that have bankers and lawyers, and it's on CNBC. And my son walks into me and said, "Dad, I told you this is the biggest mistake of your life." And so, but now he works with us, and he knows it was the right call at the right time to do that.
Safe to say that might have been one of the most well-timed trades you ever made.
It was a well-timed trade. I think it was definitely well-timed. I think more interesting to me was we waited until August of 2009 to start investing again, and that was harder timing because we were carrying 150 employees, and you're biting at the at the opportunities that you see there. But we were being disciplined, and it was an unclear market. And so we didn't make our first investment for quite some time, and then we were off to the races after we did that. But sitting and waiting and having to have that discipline was tough, but created the right entry point at that time.
That's amazing. I have a quick question for you, which is I've sat down with people like Michael Rudin. We've talked about succession planning. We've talked about family businesses. I came from a family that was in family businesses. There's a lot of long history of people who haven't successfully done succession planning and haven't successfully been able to exit their businesses because intra-family strife and stuff like that. What was it that made you guys so successful at being able to go do it while so many others have failed?
I think part of it was the timing coming off of that 90s early period of time. And it wasn't easy. We had to consolidate, and my grandfather had partners, and, everyone in the family wasn't 100% on board with going public. But, I think, it was getting through that process, getting everyone on board, using the public vehicle as a means to achieve that. And then even ultimately, as we did that, my brother and my cousin and eventually my father and uncle, realized they didn't want to be part of a public company, anymore. And so they spun off, and we spun the original industrial portfolio back to them, and they did what they want to do, is more development, more entrepreneurial. So they've been very successful in that sector. But having that flexibility, I think, was a key factor, and understanding what people's needs are. But it's not easy, right? I think at the end of the day, I think you can get through 2 generations. I think when you get to the 3rd generation, it gets very hard to do, unless that is the most important thing, right? And then you mentioned Michael Rudin, right? The Rudins, this is generationally what they're going to be. Mm-hmm. Our business is set up as a business that's a family business, broadly family business, but really we're an institution, right? And we focus on building an enterprise that's going to be sustainable beyond any one of the founders. And so if one of the of our kids rise up to that position, it's going to be merit based, not just handing the baton.
That's great. It sounds like you might have been the only one in the family that wanted to go toe-to-toe with Carl Icahn as well.
Right. That was quite the experience.
I can only imagine. I think I'll have to hold that one off, but I want to hear about it at some point.
It's a good story.
So you ended up selling the business, and then I read somewhere that a day later is when you ended up starting RXR. I think I talked to most founders, and they take a lot of time off to go out and reflect and think about what they want to do next and what they want to prioritize. Why did you end up launching the business a day later?
But first, in many times when people have asked me, like, what was my biggest mistake or regret, was that I didn't take the time off, right? Because in retrospect, we could have taken the time off. Now, the risk you run with that, and why my partners and I decided actually the same day to form RXR, was to keep the continuity of the platform, right? So we wanted to keep the people that we wanted to keep. We wanted to be positioned to take advantage of the next round of opportunities. And if it's hard to, as you know, to start from scratch. Mm-hmm. And so having that infrastructure in place, having the people, having the organization that is a competitive advantage, we felt would position us, to be more successful more quickly versus if we stopped and then had to regroup and rebuild. We with thought that would be too challenging. Now,
So did SL Green, they took the portfolio, but they didn't take your
they
people.
took some of the people. It was like Mark Holiday and I went to a room and with the organizational charts for 5 hours and negotiated who was going where.
No way. With the SL Green team?
Yeah, Mark was the CEO and I and myself. And so, but he didn't need everyone, right? Because he had, part of this was creating efficiency for him, right? He had scale. So so this was the concept. So we had this negotiation back and forth as to where that would go.
And he knew that you had the inside baseball, you had the trading cards,
Right.
and you're like, man, what's he thinking around this negotiating table?
It's actually, I think one of my team members still has the open issues list of people that he and I had marked up, Mark and I, as we were going through that negotiation. So it has it on his wall in the office still.
That's incredible. So when you ended up taking 150 employees, that means you had 150 employees on your payroll a day later. I assume you hadn't gone out and raised capital yet.
Right. We had some parts of the portfolio that we brought separate accounts in to buy that SL Green didn't want, but it was, the answer to your question is we were losing a lot of money for 2 years, right? And that's and that's hard, right? I mean, when you sell the business, you're carrying the people, and that's why I said the timing of being disciplined to waiting to 2009 was actually harder than easier than the sale part, right? In terms of, or more, I guess, more difficult than the sale part, right? The sale part was you saw top of the market, you sold, and you're able to move on, but it's the constant sort of having to write the checks and wait, and do we make a mistake? Is the opportunities going to manifest themselves? And then also flying around the world, raising capital at a time where many investors around the world were still burnt from the great financial crisis, right? So you had to go tell a story and source investors that had an appetite and willing to buy into your vision in an asset class that has just gone through this big turmoil.
And was there a gap there where you felt like, okay, I need to self-fund this thing for a period of time until people jump on board with this narrative?
We did self-fund all the way to that point in 2009. So
that's amazing.
Yeah,
and everybody got to keep their jobs, or at least the ones that were great, and
right.
and you won in the negotiation.
Right.
I mean, if you look back then and you go from Rexin, you sell that business, you start RXR, you have a blank sheet of paper. I've quickly learned that you're an incredibly thoughtful guy. What changes did you want to bring to your new organization? How did you want to run things differently?
Yeah, no, it actually, you used the word blank piece of paper. That's exactly what we did. We said, okay, we have this blank piece of paper. Myself and my partners, we sat down and we brought in some outsiders and said, okay, what was the best attributes of what it was at Rexit as a public company, and what were the weaknesses? And let's try to take the best pieces and find ways to preserve them in RXR, and then let's augment where the weaknesses and where we wanted to have that vision, right? So in terms of our reporting, our governance, our control systems of being a public company, the disciplines of being a public company, we try to build that into our our infrastructure, but then augment it with, okay, we want to get more entrepreneurial, we want to be able to expand more effectively. We're now going to the investment management business, which we hadn't been as a public company. How do you think about what do you need relative to being able to support that business, which was something that was continuing to change along the way. And so it was the advantage of having a truly clean piece of paper and using the moment to set the foundation, right? And then, frankly, there's not a year or a quarter that goes by that we're not tweaking it, right? I mean, and so because we're constantly evolving our business as we move forward.
It almost sounds like you guys went through like a SWOT analysis.
Yeah, no, right. That's right.
and then implemented a lot of changes based off of that.
That's right.
Interesting. Is there anything looking back, now that you wish you would have done differently when you got it going during the recession then?
I mean, again, in retrospect, we could have probably not have held as many people, and and since the downturn lasted as long as it lasted in the mix there. But I think when we went in, and this is again part of having the conviction in 2009 when we bought our first building. Again, and to put in perspective, it was a building, 1166 Avenue Americas. JP Morgan was a tenant for I think 10-year lease. And we spend weeks underwriting what happens if JP Morgan goes out of business. So just to put in how still uncertain the world was at that time. But from there, we went and did that, and then bought $4.5 billion of other properties over an 18-month period in New York, and for most of it, we were alone, and setting new highs, so to speak, as terms of coming the post GFC period. But they were all, in retrospect, were bargains, and we ended up selling in 2014 a 49% interest in that portfolio and got all of our capital out and kept 51%. Right, so it turned out to be right in that context of things. And I think, for us, as we were going through the process, we also were thinking beyond that, right? It wasn't, the office was the entry point for us, but really, our sort of view was understanding the urban ecosystem of New York, right? And that we spent a lot of time, I spent time in public service, and you could see sort of the regional connectivity of the New York metro area, and how that had a impact that enabled us to have the greatest level of talent. And we saw Mike Bloomberg was busy diversifying our economy from just what was financial to tech and media, venture, right? And so where was that coming from, and why did people want to be in New York? And that quality of life of living here made New York a magnet for talent. And so our investment thesis really was evolving around how do we build or buy assets that help promote or intersect with that ecosystem that was a self-reinforcing positive cycle being driven here of people coming here. And so office was a piece of it, but the other was housing, because there was an acknowledgement that how do you create affordably priced housing, but still quality of life and lifestyle that the young creative people would want to have in New York. And that's when we began to start thinking about the outer boroughs and the suburban, or we call urban suburban, transit-oriented developments as a place to grow. And began in our mind to think about almost like we did with our student housing business, where we were going to campuses and say, okay, you had a shortage of housing, we'll build your housing, and we'll supply, provide the services, et cetera. And it will be an accretive win-win for the university. And for us, we were going to municipalities that had, were commuter towns. They were like long parking lots, short tax revenue, short quality of life. And so we would pitch them on being the master developer of their downtowns, and help them build a master plan about reinvigorating their downtown. And then as part of that, we would be able to build on their land, so their parking lots and their libraries and their
lower cost basis.
Right. And then from that, we would, as long as we replaced it, and they give us tax incentives and zoning upgrades along the way. And so we ended up accumulating about 6,000 units of development rights along the New York metro area. And we had brought in a team led by a guy named Seth Pinsky, who used to be head of economic development for Mike Bloomberg. And he had done that sort of in the expanding into the boroughs and the waterfront. And so he led the charge of this with the public-private partnerships that we were doing in those markets, right? And so it's if you think about the concept is, for us, it's very consistent with our values of doing good and doing well means doing better. We're building strong communities. We're creating, in that case, places where people can live 30 minutes from Manhattan, but at 30 to 50% less than they would, create enough of a critical mass that the local businesses would evolve to be able to support this new customer base, and new businesses would come in. So you have a vibrancy of the downtown. New tax revenue, education, public safety. And so, we brought in our mind the whole economic development lens to each of those projects, not just the one single building.
Yeah, I want to come back to that in 1 second. I hear your stories about student housing, the IPO, that you guys had, and it reminds me a bit of Sam Zell's story. Did you ever intersect with Sam? Did you ever learn anything from him? I mean, we talked about Munger and our friend Warren Buffett, but I'm wondering if you learned anything from Sam, who felt like one of the early pioneers here in the real estate world.
Yeah, no, definitely. And Sam, when I was starting in the business, I learned a lot watching Sam. Later in the business, I got to get to know him better and to have a chance to meet one-on-one with him a bunch of times. And have strategic conversations. But he was clearly early on taking what was a transactional business of real estate and making it about building enterprises, right? And I think that is very consistent with how we've approached things, and also identifying niche markets that other people may not identify, and again bringing an entrepreneurial but business focused way to attack that, whether it was in Latin America or whether it was manufacture homes, right? He saw there was ways to ultimately do that. Some more successful than others, right? Because I mean, some businesses are more naturally made for that than they otherwise would be. But he was clearly a pioneer. And the other pioneer for me was Lou Ranieri, which I don't know if you ever read the book Liar's Poker. He was the movie. He was the main character there, but he invented the mortgage-backed security. So at Salomon Brothers, he went around the country to banks and basically said, "I'll take your loans that you're making to people for homes, and I'll take them, securitize them, get them rated," and then he sold them all. And he invented that product. And the movie The Big Short and Liar's Poker sort of talks about him in this mix. And so I read his book, a book about him by Michael Lewis, when I was actually away with my wife. I think it was probably 1996 or something, early 93. And I came back and I noticed that Lou Ranieri was one of our tenants. And so I called him and I asked him to have lunch, and then I'd have lunch with him every month. And, he would mentor me and, teach me about sort of financial, markets and some of the structures that he put in place. And then eventually joined our board at Recession, and has been a close friend and mentor, and, calls me his son whenever he sees me. So he's a big one. And then also Mike Bloomberg is probably my third, I would say, person that I turn to as a mentor and role model.
That's awesome. I feel like I was actually lucky enough to meet Sam as well. My old boss, Mark Gerson, and him were close. And the thing that jumped off the page with Sam to me, not only was he incredibly thoughtful, but he was like bold, and he was like shamelessly himself. I mean, even the title of his book, right. Am I being too fucking subtle? Like, with you feel like you're a little more reserved perhaps than Sam was, and you were running around perhaps the biggest real estate market in the world, post-financial crisis, and paying prices on buildings that people had never seen before. How did you keep your conviction and stay to your strategy while maybe the noise in the Real Deal and the New York Post was saying otherwise?
Again, part of it is the concept of drowning out the noise and believing what you have to do, feeling that what your belief is well grounded in research and a set of circumstances and facts that you can monitor to make sure they are playing out. If the facts start playing the wrong way, then you can't just keep running, into the fire and realize that you got to retreat, right? Which is this recalibrate reality concept I always sort of focus on in our firm. But and I think Sam clearly was bold, and as you said, that's part of what his persona was. Interesting, because I started so young. Part of our big thing is I was called humble and hungry, right? We have to be, stay humble because we're young and we're not going to be with these egos. We're never going to be able to live up to these egos when you play in New York, but stay hungry and work harder than any of them to be able to be successful. And that's how our culture has this humble and hungry approach to it, so that we don't have sharp elbows, we don't, but we, articulate what we want in a constructive way and why it should work out. And we then compromise, and you aim to get win-win outcomes in what you're trying to do. And if you're trying to build a business, right, to the point earlier about investor versus business, an investor could win a big, a big reward, right? And if it's just about making money, you could achieve that. If you're building a business, your reputation is critical, right? And people's thought about doing business with your business is critical. And so the way to do that is treat people right, but also make sure that deals that you do are fair deals and accomplish what you're seeking to accomplish for yourself as well as for your counterparty along the way.
I like that. To go back to something we talked about at the beginning, you mentioned how, focus is really important, and you guys work on this thesis at the end of every year and you come back to that thesis. When I think about you just talking about going out into the suburbs along the rail lines and doing community building, or more recently, I think you guys have expanded outwards into other states and other cities. And when I talk to a lot of real estate people, they're like,
Right.
just stick with what you know. Like it's the market that's you can walk to. What's made you change your positioning perhaps around those things? And how have you tried to develop those theses and build enough conviction to dive into them?
Yeah. So the going national one was probably the more difficult one because, to your point, their natural inclination in real estate is stick to your markets, and historically at Rexon, that was sort of our competitive advantage, that we knew New York, and even when we formed RXR, the capital that was flowing to us because these guys know New York. So if you're going to invest, we can invest in our funds, and with our funds, we could do office, we could do multifamily, we could do infrastructure, we could do credit. We could do logistics, and the investors were betting on our ability to allocate that capital in this market. That's one of the most challenging markets to navigate, and that was the premise. But they also eventually began to get over allocated in New York, and said, we like what you're doing. Can you take this model elsewhere? The second thing we saw was our clients changed how they were looking at the world. So, like, if you think back, and really what started to spark our national expansion was HQ2 with Amazon. And rather than, a company saying, okay, I'm just going to be in New York, or I'm going to be in Seattle, or I'm going to be in San Francisco, they were going to go where the talent was migrating, right? And so you began to think about them. So we began to say, okay, where, if we were going to expand, what would be our edge, and where would we want to expand? And the edge would be understanding urban ecosystems that attracted that talent, and then had the ability to have sustainable growth beyond that. And so the theme in our white paper that year we called EDS, MEDS, and Well-Eds. How do we target places that have good education systems and good healthcare systems, which tend to be proxies for where talent want to locate, and then good leadership that's investing in infrastructure, quality of life, economic opportunity, affordability, job training, so that it is a place where people would want to locate. And then from there, we would then put a lens over that to say, okay, on a sort of pure supply and demand real estate perspective, what markets would we want to stay away from? Well, markets that had more cranes than people and not enough ability to absorb, we'd stay away from.
Yeah.
And markets that didn't have a diversity of demand drivers, so industries, right? So we didn't want to be in a Houston or a Washington or even a San Francisco, because they're too one sector driven. So you wanted the diversity. So we mapped out the markets and submarkets around the country that we thought had those attributes, and then began expanding into those markets. And COVID only accelerated that migration that we were talking about. And so today we're in Phoenix, we're in Denver, we're in Dallas, we're in Raleigh, North Carolina, we're in Tampa, Orlando. We've been looking in Atlanta, we've been looking in Boston, obviously the whole New York metro area. And so, we've been taking that expansion, leading with housing, multifamily, and then expanding from there, from credit and looking at logistics. And then we've done in North Carolina, Raleigh, North Carolina, we're doing an 1,100 acre mixed use development, which was probably the one that we were most nervous about, was because how transferable is that skill set outside of New York to a new marketplace that really has to deal with a lot of the regulatory, and government groups that we normally wouldn't. And to our surprise, it's been, it's true. You can make it in New York, you can make it anywhere, because you bring a whole different perspective. And in 2 years, we're now breaking ground on what's going to be an enormous development with 8,000 units of homes and logistics and data centers and schools and.
You're doing single family rentals, or you do?
Yeah, we have single family rentals, which we're in the process of. We sold off the first 1,100 acres to Lennar, 1,100 units rather to Lennar, and then we're building some ourselves, and then we'll sell more as we go forward.
I mean, I love how you just distilled the strengths and the core competencies of you guys as a firm before you decided to go outside. So you went in with open eyes, into everything. And it's something we've thought a lot about, because as we were talking about earlier, we started as the New York seed fund, and we were only doing New York deals. And as we've scaled, people always worry, are you going to start to lose your core focus? And instead of, having one team which was B2B focused and one team that was consumer focused when we launched, we ended up deciding to have a bunch of different partners be specialists in different sectors. And so that way, if you ended up seeing deals in LA or San Francisco or Denver, there's probably A reason why you were seeing them, but B, you could bring a prepared mind into the meeting.
Right.
And then if we were lucky enough to, have built up our networks and built up our themes and our investment theses, we could win those deals. And we've started to see that play out. But it's not without being a little bit nervous of pushing the boundaries of your own strategy and for the reasons why you made money historically.
Yeah, and to your point, we've actually this year moved to more of sector specific organizational structures and leadership, right? Whereas historically, everything was sort of so integrated around the region, you could not have that sector specific area. But now we have our credit vehicle, we have an office recovery vehicle, we have a housing vehicle, and different leadership teams atop each of those sectors, so that you have that domain expertise that is transferable.
It's such a tough balance too, because in the investment world, I think what a lot of people don't think about is the fact that if you just stay too focused on one thing and you only have your blinders up, you might be missing out on a much better return. We talk about New York. A lot of returns in New York tend to be a little bit smaller than, emerging markets. And for us, it's like if you're going to focus on a sector and there's going to be maybe 2 or 3 category defining businesses that get started max on a yearly basis, you might not want to be purely focused on a single given market. You might want to be able to make sure that you're seeing the best things and then investing in those things, or you're going to miss out on the incredible returns for your LPs.
Right. And I think they're also not mutually exclusive, right? I mean, I think the thing with New York is it's such a competitive market across every sector. And so if you're going to remain disciplined on your investment focus, right, there's only so much you're going to be able to do in New York, but doesn't mean that's all your capacity. You have capacity to do, right? So by expanding and broadening that, it gives you the ability to do other things. But I'm still a big believer that there is, New York. There's no other market in the U.S. like New York, and and probably around the world, there's 3 or 4 markets that would even be on the same scale of what a New York is. I mean, it's a global city. The diversity, the demand of talent, and attraction of talent that comes here, the culture, the quality of life, the infrastructure. It's unmatched. And I travel a lot. For business to meeting with investors around the world. 90% of our $11 billion of investors are non-U.S. investors. So,
Wow.
Whether it's the Mideast or Europe or Asia, you're seeing you could see different cultures. And I spent a lot of time digging in with people about their cultures and their organizations and their urban ecosystems. And they still point to the U.S. as the most attractive investment market in the world, and New York being the best of the U.S.
It's safe.
Right.
So shift gears, because we only have a few more minutes together. What most people probably don't realize is RXR does venture capital investments as well through Ardent Digital Ventures. How involved are you over there? And I'm curious to get your take on how you would evaluate startup investments in comparison to your expertise, which is the real estate world.
Right. So, our venture investing started in 2019 in our white paper, which we called RXR 2.0, and it was an acknowledgement that our industry needed to go through its own form of digitization, and that that we were sort of arcane relative to other industries, and that if we could find ways to better collect data, analyze data, understand how people use our buildings, operate our business, we would be more effective. So we set up a digital lab. At the time, we had McKinsey and Microsoft, and set up what we called urban living and urban workplaces and urban experiences that were meant to bring in the people that are with the domain expertise that are doing the work every day to commingle with the data scientists, the engineers, the product development people, and really, ideate about, what are the priorities of what we should be focused on. in each of those areas, and setting up the foundation of a data lake and collecting now, billions of pieces of data that are actionable and usable along the way. And on a parallel basis, we set up a venture vehicle primarily because we wanted to sort of see what was out there and how that was playing through, and what was be better off us building ourselves or us investing and collaborating with another firm that had some of that technology in the mix. And so approaching that way was interesting. And we used to do these Saturday meetings at my house that Matt Boris, you mentioned, would come, and a couple others, and we'd sit around table. And I used to always get those little black and white cookies from, I forget the bakery across from Google, and bring in a couple of founders like every Saturday that would talk to us about their business and why they'd want to do something with RXR, and the rationale being obviously access to our customers, access, ability to test drive the product. What you realize quickly is that when you're investing in startups, it's really about the people, right? Because at the end of the day, there's no clear path from point A to point B, and you need to have an entrepreneur at the head that is thoughtful, that is disciplined, that's agile, and that can adapt quickly as things around them adapt. And when something doesn't work, to cut the cord quickly and move on to what the next thing is, or just cut the cord. And that's the other piece. I think the psychology of venture investing is, you got to go in knowing that there's going to be a reasonable percentage of these things that are not going to work, right? So part of the evolution to what is now RADV, was it RXR?
Yep.
Yeah, I always get confused. was to be able to expand our infrastructure, to be able to expand our product type, to professionalize our approach on investing. Matt had been here for a while with us, but really now, thinking through, which types of companies we want to invest in, which are the entrepreneurs, positioning ourselves with a competitive advantage that we would actually be able to punch above our weight to be brought into deals that a firm like RXR or RADV would not normally have access to because of our real estate competency. And to then continually build the internal muscle and commitment to having these companies' products test drove and feedback, and to give us the advantage of supporting our partners, but at the same time learning from that process.
Is there still a part of your brain, though, that, seeing a far higher percentage of losses in comparison to real estate is just always in pain?
It's always in pain. It is, no doubt. There's and that's part of the concept here, right? Is by having it isolated like that, it's something that enables you to sort of realize that's what you're getting into. So you're not looking at your own P&L or your own track record in that regard.
Yeah, well, and speaking of, I think, great founders, I heard that one of your other mentors you didn't mention is Danny Meyer, and he's a big detail-oriented guy. What have you learned from Danny?
Yeah, I think, from him and some of the other of his colleagues, really is the importance of customer service and hospitality and focus on detail, right? As you get big and technology becomes less personal, the personal becomes that much more important. And, we have built within RXR a whole hospitality arm of our business that creates programming and products for our multifamily buildings and for our office buildings, collects data on our customers, so we have an understanding of what they like, so we can provide a little bit more of a personalized level of service, particularly for our residents that live in our buildings, that nudge our concierges, when it's someone's anniversary or someone's birthday. We even provide stipends so that for each unit in our building, there's an annual stipend that incentivizes our concierges to go out and get a gift out of nowhere. So if someone has their grandchild come over, go buy a soccer ball and just drop it over, these moments of surprise and delight, right? And I think, that our business hasn't really thought in that construct, the office building and multifamily business. And so that extra level of community building and personalization, hospitality, I think creates a differentiation of our brand that encourages residents and companies to want to stay with us longer than they otherwise would.
And now that you've seen founders across hospitality, like Danny and technology with Bloomberg, and I'm sure you're incredibly well networked in the real estate world, when you meet with startup founders, what are you looking for?
I think one of the things is discipline, right? Again, because I think that that's something that's critical for a founder not to get lost in the mix of things here. As I mentioned, agility, someone that is able to move quickly, some of the track record of success, I think is an important element here because, or even failures, but just enough that they have a track record that
Yeah.
you can see that they've lived through the cycle before and they have a sense as to what that is. I think when I personally find it, more beneficial when someone's giving you sort of straight talk versus the selling you a dream that is a long way off to reality. It doesn't mean that you don't eventually get there, but I think being sober about where you are is important. And I think I like things that help break friction of existing businesses. That are, that when you look back and say, wow, that makes a lot of sense. Like, parking, right? It's been, archaic, not really something that has really been upgraded to take advantage of technology the way it is. And it's something that's a painful process. And so, when investing in this company, Metropolis, you saw how they've, used computer vision and AI to really change the whole parking experience, or coins with laundry mats. I mean, these are mundane businesses. People think, what's so compelling about them? But what's compelling is that they're making something that was painful or frictions that were there go away and actually find ways to make money along that. Right?
Ironically, that's the whole Danny thing, right? It's like both those companies make the customer experience 10x better than it was before too.
That's right.
And it also solves a pain point for the business owner.
That's right.
Well, I want to end with one last question I like to ask every guest, which is, if you were mayor of New York, what's one change you'd like to make?
If I was mayor of New York, I think I would acknowledge that what makes us the most successful city in the world is that we attract the talent that comes here. And so making sure that you have the quality of life, public safety, affordability, the key factors. This is just like we're talking about a business. What drives success? What are those 3 or 4 factors? And I would try to drown out the rest of the politics and push to make sure that you're focusing on achieving those core principles, so the city continues to flourish. And I feel like, particularly since Mike has left office, we've become more political, more partisan, more of an everything bagel sort of strategy, that instead of trying to really hit the problem head on, we try to solve every problem, and then we don't solve any problem, right? And I think that's not an effective way to do things. So focus on the core principles and resolve them.
Is this a platform that we might see you running on at some point? Awesome. Well, appreciate you joining us, Scott. Thank you very much.
Thank you. I appreciate it. A lot of fun.